let's talk about your DFS. Okay, you've refreshed it. What assumptions have you changed? What are the key assumptions that you've changed?
Yeah, well, firstly and importantly, I'll talk about things we didn't change. So what happened was in 2019, Marcel had just joined us. Marcel has a lot of experience in project management, and he said, well, we agreed that we should do a review of the DFS. We had some gentlemen come in and review it, and what they found was that the mining strategy and schedule and the flow sheet, the metallurgical flow sheet, didn't need to change. They felt that the work that had been done was world class. The fact that we'd done pilot plants for both the pits and the metallurgical flow sheet, they said, was absolutely outstanding. What they did see, though, was that the owner-operate model that we had for the mining fleet, which we had done in the DFS to reduce operating costs considerably, the owner-operator model didn't work. And they felt that we had too many people on site. So they looked at our staffing. I'll give you an example. We had 27 people working in the lab, and as it turned out, we didn't need that many. So a little bit gold-plated. So they went through it, fine-tooth comb, gave us a bunch of recommendations, and we basically went through with the engineers who did the original DFS so that there was no competitive tension, and basically went through it literally line by line. I remember seeing a line in a spreadsheet with $4,000 a year for faxes. Obviously, that's come out. But where we got the most savings was on the mining fleet. So where we were going to buy a new mining fleet for the life of the operation, we're now looking at buying refurbished equipment from a earth-moving contractor that did the test pits, who is based here in Western Australia. And they actually are one of only two earth-moving contractors in Western Australia who actually have the workshops to refit equipment. And what that means is that we'll be buying equipment much cheaper up front, and then we buy new refurbished equipment during the life of the operation out of sustaining capital, which is in the all-in sustaining cost. And they'll also come on board and they'll do a cost plus. They'll operate the equipment even though we own it. So it's basically a hybridized owner-operate contract model, and it's really the best outcome. And the fact that we saw these guys come to site, dig the two test pits profitably for them, and they were by far the cheapest contract that was tendered, and they did a fantastic job, and they were happy with the outcome. I think that's an outstanding result, and that's about 60% of the savings. The rest came from changing from an EPC model to sort of a hybrid EPC EPCM, where we'll actually have an owner's team, but some of those overheads that you get with an EPC model have been reduced. And then the fact that we were able to change the manning levels, we were able to make the airstrip shorter because we'll go with airplanes rather than jets. The camp size comes down, and you have a whole bunch of ancillary things that flow on from that. And then there were, rats and mice. There was pipeline costs and things like that we managed to come down. Steel and I know you get 20 or 30 things where you're saving $1 million, that starts to add up. So what that meant was that the capital came down by $100 million Australian, from almost 500 million to below 400 million, which is about 253 US.
What's your break even?
So that was an outstanding result.
What's your break even, Mike?
Pardon me?
What's your break even price?
36.75 is break even. So if you put that price in our model, the NPV is zero.
Okay. Got it. And you're looking for, I noticed you used to talk about looking for $60. You're now looking at 55, which I think is comparable to what a lot of people are asking for in the market as an average. Do you see that happening anytime soon?
Well, we introduced in the DFS refresh, I've introduced a new term because we know this industry loves acronyms, which is the VWC, the volume weighted contract price. So what we're doing is we're going to have a spectrum of prices, above and below 55. Some people see the price going to 65, 70. Certainly there will be utilities buying at that level, or they're not going to get uranium. And obviously, as a salesman, you might go in with a lower price up front. If you get one of the big utilities coming in, you might offer them a bit less than 55. But we do know we're getting close.
But that's not.
We'll see the next.
That's not the question.
Sorry?
And that's not the question. What you want to get versus what is happening in the marketplace is, when do you think you're going to be able to get 55 average contract price on board? Like, how much longer will you have to try and keep the lights on until the market moves? That's the question.
Yeah. Well, see, that's the problem, Matt, is you just don't know. And we talked about this before. And we have been saying for 2 years that it's next 6 months we'll get it. The next 6 months we'll get it. And Matt, I'll give you my honest answer. I don't know. I really don't know. We talk to these guys. We know exactly where their heads are at. One day they're going to pop up and say, yes, we'll take that. Thank you very much. And we're going to have to, we got 3.5 million pounds that we need to get rid of. Let's say we do 75% of that. You're talking about 2 and a bit. You don't do 2 million pound contracts. You do 200,000 pound contracts. So we're going to need 10 contracts spread across. So let's say from now till June 30 next year, we're writing contracts. Let's say by June 30 next year, we're at a point where we can start looking at funding. That takes another 6 months. You're in construction by the end of 21. You're in production by the end of 23. I mean, that's our working calendar at the moment. And obviously it is entirely existential, and that is frustrating.